partner in Lavelle Law. We have a nice program for you today, dealing business formation workshop. So before we get started, I want to introduce our panelists. I'm going to be speaking a little bit later today. We have Ted McGinn, who's a shareholder at Lavelle Law. He practices in the area of corporate transactions, M&A work, a lot of banking, lending transactions, and commercial real estate. Frank Patera, he practices here at Lavelle Law in the area of corporate compliance, business law, M&A work, and then myself, I also do a lot of business formation work, business transactions, M&A work. So we have a good panel for you today. Business formation workshop. So we're going to be getting into some of the questions that you may be asking yourself when you're trying to decide to form a business. What is the proper entity to choose? What are some of the consideration, the factors that you should be looking at, and the pros and cons for the various business choices. Some housekeeping matters. Disclaimer: today we're not here to provide you any legal advice. If you have some of these questions that is related to your situation, I would recommend that you come in, set up a consultation with us. We always provide free consultations to new clients, and there we can kind of learn more about your particular situation and really give you customized legal advice. In addition, there's no attorney-client relationship as a result of this presentation. Breakfast over there, please help yourself, don't be shy. We don't want to take it upstairs. Coffee, water. Also, if anybody needs to use a restroom, outside to the right, there is a restroom out there, so please. All right. So let's get started. Frank, you want to jump in? Sure. And by the way, we'll have some Q&A at the end. If you have any questions, say those for the end.
Good morning, everybody. My name is Frank Portera. I'm an attorney here, as Ted mentioned. We'll get started with entity selection, which is kind of the first question that one asks themselves when they're forming a new business. So the perspective of the entity selection has to do with a couple of things. You want to make sure you take care of that limited liability shield that is afforded to you under the Illinois laws or any state that you're organizing under, and that gives you a competitive advantage to kind of go out, take risks, do your business the way you want it to do it. This is because the legislatures give you that limited liability shield under the Corporation Act, the LLC Act. They want to generally keep the debts and obligations of the company separate from the individual owners. So without that, people might not be as risk averse to go out and start their businesses. So you have that competitive advantage there. The other advantage is cash flows. You can kind of manage how the money comes in, how you pay it out, how you pay taxes on that income as well. So if you're just operating unincorporated or as a sole proprietor, it's all just flowing through to you, and you're going to have to pay taxes on that, but we'll get into some creative ways that you can distinguish between that. Here are the 5 choices of an entity that you can choose from, starting with the sole proprietorship, which is just going out into the marketplace and operating under your personal name or under an assumed name with the county, DBA. This, again, is unincorporated, unorganized, so you're not afforded that liability shield. Partnership, there are a couple different types of partnerships. It's basically 2 or more people going into business together for a common purpose. General partnership is unincorporated, and then we have the LP, the limited partnership, and then the LLP, the limited liability, limited partnership. Those are organized under state law. The most common that we see are LLCs, or limited liability companies, and for-profit corporations. You can see the designations there for Inc., Corp, or Ltd, also company or co as well. Not-for-profit corporations are afforded that limited liability shield for its founders, its directors, and officers. Again, there are different kind of tax exemption applications for not-for-profits that we'll discuss as well, mainly for charitable purposes or homeowners associations. When determining what entity to select, we can walk you through this process and really explain the different factors here. The ease of formation, pretty much everything now is able to be filed online, whether it be a corporation or an LLC or a not-for-profit. The limited liability, again, whether you just want to go out and do business in your personal name, or if you want to organize your company and be afforded those limited liability protections. Again, as we mentioned before, and as Ted will speak about later on, the different taxation of the entities, whether the company is going to be an S corporation or C corporation, whether it's just a flow-through entity as an LLC. We'll talk to you about that. And the flexibility too. The kind of new age company structure is the LLC, and that's because it affords you a lot of flexibility and customization to create different types of stock or membership interest, different classes with different interests, maybe preferred units, maybe non-voting units. It offers a wide range of flexibility and customization. For corporations, that's there as well, but it comes with a lot more record keeping and reporting to the state and different agencies. Going in to discuss LLCs a little further and what they entail. First, you start with the formation of articles of organization with the Illinois Secretary of State or any similar agency in the U.S., depending on where the company is located or the analysis of the home state. Taxation, by default, of just a single member, one owner LLC is taxed as a sole proprietorship, disregarded entity. It's just as if you were operating in your individual name, but you stand behind that LLC, that limited liability shield. So again, that customization, that kind of informality there, but still granting you that liability shield. The partnership, again, is two or more persons going into business together under that liability shield. That multi-member designation is by default a partnership. LLCs are a little different, where they can go with the default tax consequences, that default tax, or they can elect S Corp or C Corp tax treatment. So you could be a single member LLC and elect to be taxed as an S corporation, and really distinguish between your ownership interest and paying yourself as an employee. So you can kind of distinguish the wages you receive and the distributions you get as an owner, and those would be applicable. Different tax rates would be applicable to those two payments. Again, LLCs have the limited liability shield, where generally the debts and obligations of the owners are separate from the company, are separate from the owners. That's a general rule. And then the operating agreement is the main kind of internal governance document that talks about the procedures and transferability of shares and how major decisions are going to be made, similar to a shareholder agreement or bylaws. A series LLC is something that we generally see for real estate holding companies or companies with different divisions or brands. And it's basically a parent and subsidiary relationship where you form a master LLC at the top with the authority to issue series, and then each new division or rental property or real estate property is created through its own subsidiary series with a separate fee to the state. And in Illinois, the series are allowed under the LLC Act. In different states, they may not be, so that's an analysis that we would do if you were an out-of-state company. For corporations, we start by forming the articles of incorporation with the Secretary of State. We prepare organizational meeting minutes of the shareholders, appointing the board, and then the board electing officers. We prepare bylaws, which are the internal procedures for how meetings are going to be held, how voting is going to happen among the shareholders and board of directors, and then stock certificates as well to identify the owners and really certificate that stock ownership. So as you can see, there's a lot more that goes into the formation of the corporations to start, whereas an LLC, you just form the articles with the state, get that EIN number, which we'll talk about as well, and then you're off and running with that operating agreement. For the articles of incorporation and the corporations, you have to have these organizational meeting minutes, bylaws, stock certificates as well. Taxation, corporations are allowed to be taxed as the default C Corp or the S Corp, the S election. Limited liability, again, formed under the Illinois Business Corporation Act. where that general rule is the shareholders are insulated from the corporation's debts and obligations, and then a shareholder agreement is something that we prepare for our corporations who have 2 or more owners. It's a good idea to get everyone on the same page from the start, agree on the transferability of shares, how major decisions are going to be made, and what happens if an owner dies or becomes incapacitated during the life of the corporation. The sole proprietorship, again, is just going out into the marketplace and operating under your name. There's no formation really, there's no liability shield, so anything that you're doing, you're personally liable for as a sole proprietor. All income would just flow through to your individual tax return on Schedule C, and there's unlimited liability. For not-for-profit corporations, there's kind of 2 phases here for the formation. The first is the Secretary of State formation through the Articles of Incorporation. If you have hopes of applying for tax exemption with the IRS, then in this phase we state the purpose as a charitable one, and we cite the specific regulations under the Internal Revenue Code to make you eligible for that tax exemption. So with that formation, we apply with the Articles of Incorporation, we get through that FEIN, that tax ID, and then we will apply with Reg 1 and the UI 1, which is the initial tax applications with the Illinois Department of Revenue and Illinois Department of Employment Security if you have employees. The bylaws are an important part for a charitable organization, these NFPs as well, to identify those purposes, and then as well we have the organizational meeting minutes of the board. The second phase is the tax exemption phase with the IRS and then the Illinois Attorney General, assuming the company is in Illinois. There are options for smaller charities that are under a certain dollar threshold. We can file a streamlined application called the 1023-EZ, but the standard form is that 1023, and it asks questions about, again, the charitable purpose, who are the directors and officers, some financial projections as well. So we help our clients prepare those and file those. The Illinois Attorney General, again, is similar but not as in-depth as the IRS. Charities and not-for-profits are to be exempt under the IRS and Illinois income tax as well. So federal and state income tax exemptions here. We do offer a flat fee formation package for $700 plus cost of filing, and that depends. The cost of filing depends on what entity you're forming. So with that flat fee formation, we file the organizational document, the Articles of Incorporation or organization, depending on the structure. We get you the FEIN or the tax ID, and then we register you with the IDOR, Illinois Department of Revenue, and Illinois Department of Employment Security, if necessary. And then we complete that corporate book with organizational meeting minutes, bylaws, stock certificates. And then we will enroll you into our annual compliance program that we'll discuss later. But that $700 flat fee gets you a complete formation packet where you can start operating, go to the bank to open up a bank account, and start operating in that name.
Thank you, Frank. All right, before we move on, any questions for Frank on formation issues? And we'll open it up later at the end as well. If you have any questions now, we can. All right, so.
I have a question.
Yes, go ahead.
2 questions, please. Thank you. Good
Yes.
morning. My name is Maria with Casey Callets. My first question is, in the second slide, it said competitive advantage on choosing which corporation best fits you. How is there a competitive advantage choosing the red corporation?
And that's a great question. As Frank mentioned, LLCs, corporations provide limited liability, which is a critical component. Now, whether an LLC or a corporation is best for you, you're going to have to decide a number of different factors. The flexibility is one factor. I'm going to get in a little bit later on S corporations and taxes and why that is important. So I think at the end of the day, when you're choosing which entity, you have to decide which factors are most important for you, and based upon that answer, choose the appropriate entity.
Okay. And another question, is there more limited liability if you choose one type of entity over another for your specific?
Yeah, it's another good question. If an entity has limited liability, it's going to be the same between those types of entities. So corporations, LLCs, they provide limited liability. Sole proprietorships, unlimited liability. A general partnership, unlimited liability. For limited partnerships, we don't see a lot of those anymore. With a limited partnership, you have one general partner and you have limited partners. The limited partners do have limited liability protection. The general partner is unlimited liability. But to answer your question, once an entity is limited liability, it's the same across the board. Yes.
In your discussion with your client, do you guys talk about what keeps it from being limited versus, I've seen some cases where
Yeah, I mean, that's a great question too. I mean, once you have limited liability, that's not the end of the analysis, because obviously there are exceptions to that rule. One common exception is when there's a personal guarantee. If a corporation is going to go enter into a commercial lease, often a landlord is going to ask for a guarantee to be signed by the owners of that corporation. And you have to be very careful too. Sometimes you may not even realize you're signing a guarantee. It's going to be in the fine print at the very end of the document. And so you got to be very careful when you're signing a contract. Are you signing on behalf of the corporation, or are you signing in your individual capacity? So that's one particular exception that you got to be very careful of. In addition, there are some statutory exceptions. One that comes out is employment taxes. If a corporation is operating, sometimes a company may have some cash flow issues, and what they do in those situations, not always, and we would advise against it, but sometimes what they'll do when they withhold the employment taxes from the employee's paycheck, they're supposed to send it to the IRS. Sometimes businesses hold on to that and use that for cash flow purposes. In those situations, the individuals making that decision are personally liable for those employment taxes. So bottom line is there are exceptions to the limited liability rule, and certainly you need to be aware of those. Okay, so let's get into tax considerations and business formations. And before we jump in, this is going to be a broad overview. As you know, taxes can be very complicated, and I'd always recommend when you're creating an entity of a business to consult with your accountant. But this is designed to kind of give you a broad overview of the tax considerations. So first of all, some perspective. Corporations, in the eyes of the law, are distinct legal entities. So what does that mean? Well, what that means is that corporations, they can own assets, they can have liabilities where they owe other parties money, they can sue and be sued, and they can earn income. They can make money. Okay? So when a corporation earns income, the IRS is going to tax them on that income. Okay? So it's a distinct, separate legal entity, distinct from the owners. Another concept that comes into play is double taxation. You guys heard of double taxation, right? What is double taxation? So, as I mentioned before, when a corporation earns money, earns income, it pays taxes on that income. But then the corporation will pay a dividend to its shareholders. And then when the shareholder receives that dividend income, those individual shareholders have to report that income on their own personal 1040. So they're paying tax on that dividend income. And so in other words, the corporation pays tax on that income, and then the shareholders pay tax on that income. That's double taxation. Okay, we don't like paying taxes, and so that's why double taxation is something that's, it's not good. It's not good. Okay, a flow-through entity. What is a flow-through entity? Have you heard that phrase before? A flow-through entity, there are certain types of entities on the Internal Revenue Code that they don't pay tax on their income, but instead they report the income on a return to the IRS. And then that flow-through entity allocates that income to the individual owners of that entity. And then the owners pay tax on that income that is allocated to them. So in that situation, when you have a flow-through entity, there's only one layer of taxation, okay? So generally a flow-through entity is something that's preferred, especially for smaller operations. Okay, so an S corporation. An S corporation is a flow-through entity. Okay, so that's something that we see a large number of entities or businesses that are set up as S corporations. So it's a flow-through entity. It avoids the double taxation problem. Now there are some formalities though with an S corporation. You have to file Form 2553 to elect to become an S corporation, and you have to be careful because there's a deadline for that. If it's not filed timely, then you would be by default a C corporation, and you're stuck in that double taxation. And then in addition, all the shareholders must consent to that election. So that's what an S corporation is. It's a flow-through entity, avoids double taxation. Now, there are some problems with S corporations, though, because there are particular restrictions on becoming an S corporation. You have a limitation on the number of shareholders. So if you have a large organization with, thousands of shareholders, you can't be an S corporation. Point number 2, and this is kind of an important issue, consistent economic rights. So you don't have a whole lot of flexibility when you're creating an S corporation. With an LLC, and Steve may get into this a little bit later, but you can come up with a number of different economic structures. You can have your standard common dividend. You could have a preferred dividend. You could have some sort of preferred participation dividend. There's all sort of different economic structures that you can come up with that you can get into with an LLC. S corporation, on the other hand, that's not available. It has to be a consistent economic right, and sometimes that could be a problem. And then finally, there's some limitations on who can be shareholders. Other corporations, unless it's an S corporation, can't be a shareholder of another S corporation. There's you have to be domiciled here in the United States. So there's a number of restrictions on who can be a shareholder in an S corporation. So when you start thinking about those questions, you have to ask yourself, who are going to be the shareholders? You're going to be the owners of this business. All right, limited liability companies. Okay, so generally a limited liability company is also a flow-through entity. Okay, so that's, again, it avoids double taxation, so that's beneficial. They're generally defaulted as a partnership, or if it's owned by one person, as a disregarded entity. No elections required. And then here, there's no restriction on who can be owners. So again, we're talking about the S corporation. There's restrictions, there's limitations on who can be an S corporation shareholder. LLC, you don't have that. You don't have that. And then the last point, which I kind of mentioned before, there's no restriction on economic rights. So if you want that flexibility, you want to have the ability to come up with multiple different economic structures for your owners, an LLC may be the way to go. All right, let's talk about employment taxes a little bit. So we all have been employees. You get a paycheck, you look at the bottom line, you're like, what happened to all my money? Went out with employment taxes, FICA, Social Security, all that slice off the top, and you get this net amount. So we don't like employment taxes, right? So when you create a corporation and you're working for that corporation, you get a paycheck. You get a weekly paycheck, and you're paying employment taxes on it. However, what about profits? What about profits? So you operate a corporation. You hopefully you're making money. You're generating profits. You pay yourself a paycheck, of course. Your wages, that's subject to employment taxes, but profits are not. Profits are not subject to employment taxes. Okay, so what does that mean? That means you have the ability to kind of shelter some of that positive cash flow and shift it over in the area of profits, of income, rather than wages. Okay, and so if you're over in this category of income, of profits, you're not paying employment tax on that. Now, LLC is different. LLC is different because profits are subject to self-employment taxes. So the key takeaway here with the corporation, you have an ability to try to shelter some of that positive cash flow out of employment taxes, which means the bottom line is you come ahead in the long run on your tax bill with a corporation. Now you got to be careful though. You can't get too aggressive. Okay, so if you're working for a corporation, you're working 5 days a week, 40 hours a week, and you're going to say, okay, well my paycheck is going to be $1,000 for the whole year, and everything else is going to be income. Okay, so you got to be careful with that, because if you come in and the IRS audits you, the Department of Revenue comes in and does an audit, and you're saying, wait a second, you're you're paying yourself a wage of $1,000, but you have profits of $200,000. Okay, so there you have the risk that they may come back and recategorize some of that income and shift it over to in wages.
You're talking about business owners.
Yeah, business owners. Yeah, when you're a business owner, you can decide what you pay yourself, whatever you want. I mean, you have that choice. And bottom line is, it's cash coming out of the business, and whether it's a form of wages or profits, probably doesn't really matter to you that much. You're getting the same cash, same dollar, and so the strategy is to try to shift more in the area of income and less in wages. But again, if you get too aggressive, you could open yourself up to potential an audit and a recategorization of that income.
Is there a rule for reasonable compensation, like
The rule is reasonable.
Oh.
What does that mean?
Is it like 20%, 30%?
No, there's no hard and fast rule. I mean, basically, you should be paying yourself a fair market wage. So it depends on what you're doing. If you're working as a as a CPA, what does a typical CPA get paid? Versus so that it's basically you should be paying yourself a fair market wage. Now you can kind of aggressive and get on the bottom line of that and still be protected.
Thank you.
Yep.
Well, then those are also to take into consideration, Social Security down the road when you do retire, that you might not want to have your wages too low
Yeah.
in that calculation.
Sure.
For 35 years.
Right. Yeah, that's a good point. Yeah, that's a good point. So recently we've seen a trend towards regular C corporations. Okay, so now as I mentioned before, C corporations, double taxation. It's bad, we don't like that. But what happens if the corporate rate is much lower than the individual rate? Okay, so if it's an S corporation, the money comes out, you're paying tax at your individual rate, maybe that tax rate is higher than the corporate rate. And furthermore, let's say you don't plan on distributing those profits anyway. You're a startup. Maybe you're going to keep the cash and reinvest it in the business. We need to buy this. We need to spend money in advertising. We need to, whatever you're going to use it in the business, and you don't plan on distributing it. So maybe the strategy, keep it in the corporation. You're paying at a lower rate, and so that's another possibility that you may see. Another, we've seen a trend of that lately, fairly recently. So that's another component. What is your plan? Are you planning on taking the money out of the business? If so, maybe the flow through entity makes sense. But if you're going to keep it in the business, maybe C corporation is a factor. And then also, you have to think about, are you planning on raising capital in private equity? Okay, you're going to go to the market and raise capital from private equity. They don't really like S corporations. If you're going to take an investment from some investment company out there, why don't they like S corporations? Because with a flow-through entity, they're going to get an allocation. Whether they get the money or not, they get that allocation, and they got to pay tax on it. They'd rather get a dividend, and they pay tax on it, but they know we got money for it. Okay, so private equity, they generally prefer regular corporations, and again, the flexibility is a component as well. So you got to understand. You got to think about, what is my goal? Am I going to go out there and raise capital in the private equity markets? If that's the case, maybe a C corporation is the way to go. Final takeaway, S corporations provide the best opportunity for lower taxes, but less flexible. So that flexibility is important to you. An LLC may be the way to go. LLCs, again, they offer the most flexibility for you, so if that's an important factor, that's probably where you need to be. Both LLCs and S corporations have the same limited liability protection, so that's really not really a factor between these two choices. It gets into flexibility and taxes. All right, that's a broad overview on taxes. I know, again, it's a deeper dive. There's a lot of more issues there, and I would recommend having these conversations with your accountant. Yep.
Ted, thanks for that first section. My question is, if a company is its plan at some point is to be acquired by a PE firm, am I hearing you right that maybe going in on a regular corp is potentially a good way to start early on?
You'd have to look at your time frame too. I mean, maybe there's possibilities you could convert these companies from an S corporation into a C corporation, or even convert to an LLC. Those are always possibilities as well. But I think, you know, an acquisition versus an investment. If I'm gonna invest in your company, you're gonna keep running, let's say you're gonna keep a majority, and I'm just gonna invest, you know, get a 40% stake in it. As a private equity company, they may not be comfortable with an S corporation because they don't know if they're gonna get any money. I mean, they want a dividend. But if you're gonna sell it outright, there are, you know, there are other factors that a private equity company would look at as well. Sometimes they get worried about, you know, was the S corporation created properly? You see a lot of F reorgs to convert it to get away from the S corporation. So there's a lot of variables, but yeah.
You said that for the LLC, an entity can own it as well, not just individual
Yeah.
shareholders.
Correct.
What would be the benefit of like an S corp having a share like of an LLC?
I mean, an S corporation own an
Yeah,
LLC
like,
or?
we have an S corporation
Yeah.
and we have an LLC,
Yeah.
and we own the LLC personally. But what would be the benefit of our S corporation owning our series LLC?
You know, I don't know. I have to think more about your structure. I mean, sometimes, you know, there's statutory reasons. I know home health care is an area that we do a lot of work where there's like a 36-month rule on transferring ownership, which you get a parent subsidiary structure makes sense there. In addition, having multiple entities makes sense where you don't want to have all your eggs in one basket, so you can insulate one business from the other business. But I have to sit down and find out more about your structure. Go ahead, Steve.
Yeah, so a common scenario would be like you have a parent, and say you own both, you know, an operating entity as well as real estate. So you can have a parent company own an operating entity, right, as a subsidiary, and also own a real estate holding company, an LLC. And then you kind of have separate buckets then of assets and liabilities, right? And then you have a lease for that real estate from the LLC to the operating company. So that's kind of a way to kind of segregate assets and liabilities, kind of create different buckets.
My question is, why would the owner of the operating company not just make himself an individual owner of the LLC versus making his operating company the owner of the LLC? Do you get what I'm saying? Like, if he's the only owner, does that make sense?
Yeah, so he would, I mean, he in that case, he could be the owner of both the,
Individual.
in my example, he could be the owner of the LLC, which owns real estate, and then he could be the owner of the operating company.
Mhm.
He'd still have that kind of separate
Yeah.
buckets of assets and liabilities.
Mhm.
And you definitely want your real estate in a flow-through entity for tax purposes.
Thank you.
Yeah, I mean, we have to sit down and kind of understand what the pros and cons of that particular individual.
Thank you.
All right, let me turn it over to Steve. You're gonna, or Steve or Frank, we started with social compliance. Frank?
Yep.
All right. Hello, everybody. Now that we have your corporation formed, we have the entity selection, the LLC or corporation or not-for-profit, and we have the tax elections all worked out, we're going to talk about your annual maintenance, your corporate compliance throughout the years of the life of your business. So this is another flat fee service that we offer to our corporate clients. This includes upholding that limited liability shield. So as Ted mentioned before, signing personal guarantees, you know, signing anything on your individual name and not on behalf of the company would be an exception to that limited liability shield. Another exception is not filing your annual reports with the Secretary of State. So after a certain amount of time, the Secretary of State will administratively dissolve your company, and that would open you up to personal liability. So each year you have to pay the fee to the state and file that report. For corporations, you can see the prices there. For corporations, we offer this for a flat fee of $3.99, LLCs $2.49, and then not-for-profits $3.99. With the corporations and not-for-profits, in order to fully comply with the Business Corporation Act, you not only have to file the annual report, which computes franchise taxes due to the Secretary of State, but you also have to hold an annual meeting of the shareholders and board of directors. So a lot of our clients think it's a little silly if it's a single owner corporation, you know, you're just holding a meeting talking to yourself. That's not really the case. We just want to document each year that you're really acting like a corporation, you're following the formalities, so that God forbid you're ever sued or you know, you're acquired at some point, that that company that's acquiring your business is going to want to see you know, in our practice, at least 10 years of your last annual meeting minutes or informal actions of the shareholder and board, making sure you're going through those motions, upholding that liability shield the correct way.
Hey Frank, why don't you talk a little bit more about piercing the corporate veil? I know you kind of touched
Yeah.
upon it a little bit, but I think that's an important concept.
Sure. Yeah, just following corporate formalities is kind of the essence of this, making sure you're complying with the Business Corporation Act. If you are kind of commingling funds between your corporation's bank account and your personal bank account, you're paying your home expenses through the company account, that's commingling funds, and that would weigh in favor of piercing the corporate veil. So a creditor could come along, say ABC Company is a borrower for this lender, and the lender sues to collect on that defaulted promissory note or that loan. They go in their discovery and see that the corporation has never really been acting formally as a corporation. The owner has really been using it as a shell company, paying expenses that it should not have, paying personal expenses, not holding annual meeting minutes. There's a good argument there that the corporate veil is going to be pierced, and that individual owner is going to be liable for the debts and obligations of that company. So the general rule, again, as we mentioned before, you form this LLC, this corporation, to shield yourself, to go out and take risks, to make sure your personal assets and your personal liability is separate. But if you don't follow these corporate formalities and you start commingling funds, you open up yourself to that personal liability. So for our clients, we're always a phone call away, and we're able to help. Yeah.
Just to clarify for my own understanding, as long as you're doing things by the book, so if you do something personal and you mark it as a distribution, then it still maintains clean and you're not hitting, any thresholds that you're not supposed to, then it's still clear and it cannot be.
Yeah, so long as you're paying yourself as a real employee or as a real shareholder.
And whatever you do personally, write it off as a distribution, and so you're kind of maintaining in that clean line, right? So.
Yeah, as long as you're keeping accurate books and records, and you're not paying, going on a shopping spree with the company card or anything like that. Yeah.
So you mentioned you go back 10 years, so let's just assume that, I come to you and I wanna, do my stuff, and you notice that I haven't been running any books out there, but now I want to go.
Yeah.
Is it better to start a new entity and then just start over from the beginning, or is there a way to kind of go backwards,
Yeah.
or you always have that over your head?
Yeah, I wouldn't say that, if you don't have years 2014 through 2024, somebody's going to come knocking on your door and say you're not a real corporation. It's only kind of a precautionary thing. I wouldn't recommend forming a new company. I think we can kind of go back and clean up your books for you to make everything.
Forming a new company, there could be some tax consequences
Yeah.
of transferring the old company to the new company, but yeah.
Yeah, it's a problem that we can solve. That's not a big deal. As we mentioned before, as Ted mentioned, and as I mentioned before, the LLCs are kind of the new age entity. You can see there's no parentheses there for annual meeting minutes, and that's a nice thing. You don't have to hold an annual meeting of the members or managers of an LLC. Under the LLC Act, you just file the annual report with the state, and you move on to the next year. So that's why that rate is a little lower. The cost of the Secretary of State filings are on. There's a base rate of $75, as I'm sure any business owner knows here. With corporations, it could go up depending on the paid-in capital and franchise tax, which is the stuff we can get into. If you have a certain situation, but for LLCs, that rate's almost always going to be $75. For not-for-profits, that rate is $10. Out-of-state companies, this is something to keep in mind as you operate your business through the years. You're organized in Illinois, but say you start opening up maybe a branch office in Indiana or Wisconsin or Iowa. We have to do the analysis of, are you doing business in that state? If you are, we would recommend applying for authority to transact business in that state as a foreign LLC or a foreign corporation. Again, foreign in this context just means an out-of-state company, not really an out-of-country or international company. So say we have a client that's first started up in Palatine, Illinois. It's growing and wants to open up a branch office in Milwaukee, Wisconsin. It hires employees in Wisconsin and takes out a lease in Wisconsin. Technically, that company should apply for authority to transact business in that state. each year they would file an annual report in Illinois and an annual report with the Wisconsin Department of Financial Institutions, which is their the equivalent of the Secretary of State up in Wisconsin. So we can help with that analysis as well. Again, that affords you all of the benefits of the out-of-state, that Wisconsin corporate law or LLC law, as well as the Illinois laws. So you can sue up there to collect money, and you can take advantage of the corporate laws up there. Domestication is the process by which a corporation or LLC that's formed in one state can move its domicile or its state of organization to another state. So say you have an Illinois company, but you're moving to Florida for good, and you're not going to have anything to do with Illinois ever again. We can domesticate that Illinois company in Florida, and then keep that same tax ID number, keep your tax history and all your books, but just the home state is now in Florida. We also see that with companies that are getting ready to sell, maybe to an angel investor or a private equity firm. Maybe they want to incorporate or organize in Delaware, because that's kind of our national corporate law, so we can help with that as well. The Corporate Transparency Act is another key component of corporate compliance, and this is a new law that came out this year. But it basically aims to combat illicit activity, tax fraud, money laundering, financing for terrorism. It's put out by the federal government, the U.S. Department of Treasury, and their agency called FinCEN, or the Financial Crimes and Enforcement Network. So they want to put together a database of all the beneficial owners, which is a term of art that we can get into. But generally each company registered with the Secretary of State must file this beneficial ownership information report within a certain period of time. And there's a couple of exemptions that we can help analyze, but mainly pretty much every company is tasked with filing this report. Here are the exemptions. Kind of the main ones that we see for our clients are the tax exempt entity at number 19. So any of your not-for-profits that are 501c3 entities exempt federally do not have to file this report. And then we also see the large operating company exemption in line number 21. The large operating company is a multi-pronged test, but basically it says that any company that has 20 or more full-time employees or more than $5 million in reported gross receipts or sales over the past year is exempt from this Corporate Transparency Act, is not a reporting company under this act. So that's kind of the two most common exemptions that we see for our clients. If you don't fit into any of these categories, you have to file this, hopefully one-time beneficial ownership information report, this initial report with FinCEN.
And this is included in your compliance work for clients?
This is a separate flat fee for $149 that we offer to our clients. Yeah. Just because not all of our corporate clients have to file it, so we kind of break it out that way. To file the report, we have to do the analysis of who a beneficial owner is. The beneficial owner it's kind of a two-pronged test here. Anyone who exercises substantial control over that company, or anyone that owns or controls 25% or more of the equity or ownership interest of that reporting company. So the substantial control test, you look at anyone who may fit these four criteria here. Anyone who is a senior officer, who has authority to appoint or remove certain officers or directors of the company, anyone who's an important decision maker who operates the day-to-day business of the company, and then just kind of a catch-all, anyone who has any form of substantial control. So these vague terms that are set out by the U.S. Department of Treasury and its regulations, we can help analyze these and do a review of your corporate structure and make sure we're catching all of the beneficial owners here. And then the ownership interest one, is a little easier to identify and look at who owns 25% or more of the ownership interest. But there are certain other items that we have to look at in terms of stock options, non-binding privileges, other instruments. Anyone that holds these kinds of instruments may be a beneficial owner. You can qualify under both of those prongs as well. Here are the timelines again. We offer the filing of this BOIR for our companies, our existing companies for 149. And then for our new formations, we just lump it all into that $700 formation fee. Since we're starting out, we're getting you that complete formation packet. So we just file the new formations right away so we get it done. But any company that was formed before January 1st of this year has until the end of this year to file it. Any company formed during this year has 90 days from that formation date to file it. And then any company going forward formed after January 1st of 2025 has 30 days after the formation to file it. And there are hefty penalties and fines for not complying with this act that you just don't want to mess with at all. So it's best to kind of do that analysis. Contact us if you have any questions and get this filed again. 149 for us to file this for you. And it's just an initial filing, one-time thing, unless any information changes. So if you bring on a new owner, you'll have to update those records with FinCEN. If you change your address or you change your corporate name, any kind of substantive information changes, we'll have to file another report. But if it's a tightly held company, just a family company that stays the same, it should just be a one-time filing. Any questions on the annual corporate compliance packages or anything like that? We'll have Steve talk about shareholder and operating agreements.
Thanks, Frank. Morning, everybody. How are we doing on time check?
15 minutes.
15?
Yeah.
Good. All right, my name is Steve Magala. I'm here to talk about the shareholder and operating agreements. So when we talk about drafting or analyzing these, within our firm, there's 5 categories of kind of issues that we want to make sure that the agreement addresses: management continuity, managing major events, transferability of the interests, making sure that there's a non-compete in there if that makes sense, and also ensuring the ability to sell the company. So we'll break these down. First one, management continuity. So what we want to do here is really kind of control the election of the directors or the managers, and really just provide for continuity of the management and smooth operations. We'll look at the number of the directors and managers, making sure that the number makes sense. We'll control, if the parties want to specify who these people are going to be going forward. We'll put their names in there. And just always, we want to make sure that management continuity is there. Sometimes we'll use proxies to control the voting, if that makes sense as well. So the first category is, who's management, and let's make sure that that kind of stays consistent. So, and then next category of issues that we deal with are we call planning for the 3 Ds, right? We want to know what happens on death, disability, or divorce of the owners, and some other triggering events too that we'll consider are bankruptcy, voluntary termination, or expulsion for bad actors. So let's get into each of these. Transferability, we'll want to talk about looking at each major event to ensure that the ownership interests are not transferred, right, to an unacceptable third party. Divorce situation, do the other partners really want to be in business with a potential spouse that could be, upon divorce, that could be end up being a business owner? Probably not. So we want to make sure that we consider that in drafting or reviewing the agreement. With respect to making sure that those interests are sold or liquidated, there's really 2 basic approaches here, right? So first, either the company can redeem those interests and purchase them, or the other owners, do some sort of right of first refusal or something, can have purchase those interests as well. So it's really important to kind of figure out in each of those events, death, disability, divorce, we know who's going to be who's got a right or an option, or who's obligated maybe to purchase these interests. I'll give you an example of where there's tension here, and we have to resolve the tension. Say we have one member who dies, right, and now the estate has this interest, and, you know, what does the estate want, right? What do you guys think the estate wants? Does the estate want to generally hold on to the interest, or do they want liquidity, and do they want to sell the interest back and get the cash and distribute it to the kids?
Money.
They want the money, right? So from the estate's perspective, they want to be able to kind of force that redemption or force that sale, right? They want essentially a put option. But you know, the other members, the other surviving members, what's really kind of in their interest, right? Well, I don't really have the cash to, you know, pay for that interest, so, you know, maybe, you know, maybe we're okay with, you know, whoever under the estate plan is supposed to get that interest, maybe we're okay with them, and maybe we don't want to, you know, have to have the company or us go out of pocket and purchase that interest. So, you know, from their perspective, they want a call option. They want to have the option, but not the obligation, right, to be able to purchase that interest. And so you kind of have to resolve that tension when you're having these discussions with the parties, and just, you know, just try to figure this out in terms of, you know, what do you guys want to have happen?
Is it common to have different numbers for different situations? For example, disability, there's a formula for death, there's a formula, and for divorce, there's a different formula.
There certainly can be. There can be like certain purchase price determinations that are more favorable for certain events. So, you know, if it's like, you know, like expulsion, for example, or for cause termination, could be a reduced purchase price. Something like disability or death, probably not, right?
How about divorce?
Divorce, I don't know, probably not, I would say. I mean, you know, it's not something that's really kind of, you know, it's hard to say that that's kind of the fault, really, of the divorcing member, right, in terms of from the company's perspective.
I've seen it a lot of times as like an involuntary transfer, so
Yeah.
I think divorce would fit in that category, but again, if you get too aggressive, you know, will it be enforceable by, you know, by the courts? I mean, are they gonna accept that, depending, again, depends on how aggressive you get, if you want.
Right, and keep in mind, it's generally gonna be binding on everybody, right, so you want the same provision applying to you, so. So these are all things that we have to consider. So yeah, that example is kind of a, you know, with the estate and the decedent's estate, you know, that's an example of the tension that we have to resolve, so. All right, so also as part of transferability here, when we talk about, you know, planning for the 3Ds and some of these other events, you know, if there is going to be a redemption or a cross purchase, what's the value of that equity going to be? Generally, it should be a fair value, right? Because you want these rules to kind of apply consistently across the board to everybody. You know, so it should be a fair value, should apply to all owners. And then we have to think about how do we go about valuing, you know, the interest. There's different methods, appraisals, formulas, or some sort of annual agreement. We generally like formulas. Annual agreements, you know, the parties don't often agree every year, let's face it, right? So they don't often, you know, come together to agree. Appraisals, you can get into a battle of appraisers, you know, that could be kind of tricky. Formulas, I think, are, you know, probably the easiest of the three from my perspective, my experience, so I tend to like those. We want to permit transfers for estate planning purposes, the next bullet here. Generally, you want to allow transfers to, you know, irrevocable trust for estate planning purposes, things like that. When we talk about funding any sort of buyout upon death or disability, we'll want to look at two different options. First, you know, you can get life or disability insurance that creates a pot of money, funding source to be able to buy out the interest. That's very, very common with the shareholder and operating agreements that we put together. Another option is essentially seller financing, right? So the company or the member can you know, take back the selling member or estate or whatever can take back a promissory note from the company or the shareholders and finance the purchase that way. And then, you know, another one of the events is maybe we want to expel a shareholder or a member if they're, you know, if they're not performing or if there's for cause termination there or some other events that we want to, you know, think about where, you know, they should really no longer be a shareholder or member. I mentioned disability as another event. And when we have a disability event in the shareholder operating agreement, we typically like to do is kind of define it, have kind of a standard definition, but also then tie it to the disability insurance policies. We want to make sure that if there is going to be a disability insurance policy that's there for funding purposes, that we want to make sure that we kind of incorporate their definition of the policy of disability to make sure that they're consistent. And then overall, the agreement for state tax purposes for the owners, we want to make sure that it satisfies these three characteristics so that the IRS will respect the shareholder or operating agreement, modified arrangement. It's not a device to transfer property to family members, and it's comparable to similar arrangements. So, generally, as long as it's, the parties are working together in good faith, and there's some antagonism there in terms of maybe what they want, then those three interests or those three elements will be satisfied. The next category of issues that we often look at for shareholder and operating agreements is non-compete. Non-compete in a shareholder operating agreement is good in Illinois, certainly easier to enforce than an employment agreement. There's been a lot of changes in Illinois employment law with respect to non-competes and non-solicitation covenants. So with an operating or shareholder agreement among the owners, it's not really tied to employment. Consideration is clear and certainly can be easier to enforce. This other category here, ensuring the ability to sell a company. We want to make sure that that's also provided for in our drafting or review. So here there's two components. There's a drag-along and tag-along, right? So the drag-along really kind of benefits the majority shareholder to enable the sale of the entire company. So it prevents really kind of the minority shareholder or member from holding out, and so that the majority can basically force the sale of the entire equity of the company to the buyer. And similarly, kind of conversely, I guess, is give a tag along, and that protects the minority shareholders. So if the majority negotiates a really good deal with the buyer, and the majority doesn't want to give them the same deal, the same terms, that tag along right can kind of force participation by the minority. Again, we want to ensure that the entire equity is capable of being sold. So, yes.
They have to agree to that, right?
Yeah, these are obligations, covenants that are in the agreement that the parties would sign.
And you have that agreement well in advance, any potential sale?
Yeah, when we're drafting the agreements, we generally put them in there.
We recommend doing these when you create the company. Now,
Right.
sometimes cash is tight and people don't want to invest the money in these agreements, but in the long run, these agreements save a lot of money because otherwise you got parties litigating with attorneys. So this is really designed to have a roadmap to address these issues in the future.
This
Right.
is page 76 out of our 80-page agreement that we have. It's usually
With your firm?
Yeah.
Yeah, right. So yeah, again, the goal is to ensure the ability to transfer the entire equity interest to a buyer. And then, as part of that, the last bullet here, defining the voting requirements to approve that sale or merger to a buyer. We want to make sure that we want to get those voting percentages right. Sometimes maybe they're just, depending on who we represent, maybe they're just a majority, maybe they're 2/3, it all depends. So the higher the voting requirement, obviously, the more difficult it would be to get that sale or merger done. Okay, turn it over to Ben.
Okay, I know we're at 9 o'clock, so I'm just we got a couple of different programs I want to kind of just go over real quick that we have that we're starting at Lavelle Law. First of all is an entrepreneurial package. A lot of people starting up a company. This is designed for somebody starting up a brand new business. It's our entrepreneurial package. For that, you get the creation of an entity, whether it's an LLC or a corporation, and then in addition, you would also get a contract. When you're starting a company, chances are you're going to want an agreement that you can use with your customers. As Frank mentioned before, our formation is $700, flat fee. But a contract, drafting that typically could be $1,500 to $2,000, depending on the terms that you're going to put in that agreement. So for this package, It's $1,500 flat fee, and you get it's a really good deal for somebody getting started. You know, again, you need a contract to protect yourself. And then number two, outside counsel. So large corporations, they typically have general counsel on staff working for that corporation. That general counsel typically is there to advise management on legal issues that pop up from time to time. So with Lavelle Law Outside Counsel Program, we charge a flat fee, $500 per month, and for that you get 2 30-minute phone calls a week to address any sort of issues that you may be dealing with, such as employment law issues, maybe intellectual property matters, contract matters, maybe litigation strategy. It doesn't include filing a lawsuit, doesn't include drafting contracts. It just includes that 2 30-minute phone calls a week. So it's just a good opportunity for a smaller business to have access to an attorney to get some guidance on a regular basis. And I have a couple flyers up here that if you're interested in any of those programs, come on, stop on by, and I'll give you a flyer, and we would happy to help out in those situations. So with that said, any other questions before I bring you guys on the rest of your day?
For the outside counsel, does that include like reviewing maybe what we already have existing, stuff like that, or not that deep? Or just for general questions?
Usually for general questions, like a 30-minute phone call. I mean, if you send over an agreement over the course of that 30 minutes,
Yeah.
I mean, if it's a long document, it may be difficult to tackle that in 30 minutes, but it's more like designed if I need this person showed up late 3 days in a row, I want to fire this person. How do I do that without, subjecting myself to wrongful termination? Or I have a customer's not paying the bill. How do I go and collect? Things of that nature.
Thank you.
The other thing I was gonna ask about foreign LLC out of state companies. Do you have more information about them, like the taxes? Like sometimes we supply customers in Pleasant area, which is the borderline.
Mm-hmm.
How does that work?
Oh, so you're doing work across the state lines in
We deliver
Wisconsin?
products sometimes to that area.
Yeah, I mean, I guess.
So when do we have to
Yeah, I mean, the
Like-
question is, are you doing business in Wisconsin?
Yes.
And so that's the
So when do we
question.
apply for that?
Yeah, obviously, if you open up an office in Wisconsin, you got workers in Wisconsin, clearly you're doing business there. But if you're just doing a simple one-off transaction, maybe it happens on a regular, ongoing basis, maybe you are crossing the line, you're doing business in Wisconsin. But if it's just like a one-off sort of situation, chances are you're probably not.
And what happens if we are doing that? Like, do we have to pay more taxes to Wisconsin out of the profits of that, or how does that work?
Like, we don't have any employees, we don't contract anybody from there, but sales do occur on a
Yeah,
frequent
is
basis.
it frequent?
Frequent
Yeah.
basis, yeah.
Yeah, I think you'd have to sit down and do a more deeper dive on that. If you're
CPA
doing business up there, then you're probably subject to taxes in the state of Wisconsin, if you're doing business in that state.
And is that with an attorney with you guys?
Attorney or an
CPA?
accountant, either one could probably help you out with that.
Ask your accountant to look at your, they call it SALT, your sale, your tax liability. So if there's a certain threshold every state has, well, your accounting firm should have a group that deals with that. They'll do an analysis and let you know, like a nexus study almost, right? So.
Yeah, state and local
Thank you.
taxation, yeah.
Thank you.
Thank you.
They are aggressive too, like Wisconsin is aggressive, when you do a business, they want their sales tax, and they want their income taxes to do business in their state.
Illinois gets aggressive too.
Oh,
You
yeah.
can start leaving
A lot of
the state
states
of
are
Illinois, they
aggressive,
want
yeah.
their income tax,
Yeah, they want
their
their tax.
tax, sales tax, yeah. No
Thank
question.
you.
But if you pay taxes in Wisconsin, then you don't have to pay on that portion of Illinois, so, but the rates are the same, 5%.
Oh, so instead of giving that pie to Illinois, you're just gonna give that part of the.
Yeah, then you
pie
got
to
to put it over there. yeah.
Oh, that's cool, thank you.
Talk to your accountants, and then, if we need to help you with the application to do business in Illinois or Wisconsin, we can do that.
Thank you.
When we say limited liability, what things are protected?
Limited liability, so the general rule, the owners of the company, the business is not liable for the debts of the business. So that would be if, like rent, it would be wages for employees, vendors, anything the business hires or does, any sort of liabilities the business generates, the owners would not be personally liable. And again, there's exceptions though. If there's a personal guarantee, now all of a sudden you are personally liable. So limited liability would cover virtually all your liability if you're operating properly.
But it's really just debts,
potential lawsuits, it would cover that as well. You know, and again, there's exceptions. You know, if you're an accounting firm and you engage with a client and you commit malpractice of some sort, they're going to sue the company, but they may also sue that individual CPA who committed malpractice. Or if you're a doctor, okay, you do a surgery, you're operating in a corporation, but that doctor also commits malpractice. That the company's going to get sued, but also the individual doctor. But the other owner doctors had nothing to do with the surgery, they're protected.
My question is, so if you're gonna sort of engage with you guys, what would you recommend we come in prepared with? Like what type of, is there sort of a checklist of stuff we ought to think about in advance as you're being prepared to be able to have a conversation with?
Yeah, I mean, I think if you're gonna starting a business, if you have multiple owners, it may be a good idea to have them come in and be ready to be there. I mean, you know, if creating a shareholder agreement, we have a nice checklist that we typically provide our clients to address some of the large issues they should be thinking about, and we recommend that the owners get together, talk amongst themselves, kind of try to arrive at a consensus as to how they want these issues handled, report back to us, and we create a draft. And then it goes back to the owners. This person may like that, this person doesn't like that, there may be some, again, back and forth, but that's typically how we work.
Yeah, we have a new entity checklist, geared for LLCs and corporations, and then we also have, like Ted said, a checklist of issues to consider for a shareholder operating agreement especially if there's gonna be more than one member.
That's helpful. Thank you very much.
Yep, all right, well, thank you everybody for coming. Do you have another breakfast briefs, what, November probably?
In November, I believe, yeah.
November, keep your eyes open in your email, probably, I think employment labor law in November, so, again, thank you for coming.
Yeah.